With all of the talk about impeachment, the trade war with China, and market signals of a slowing economy, are you looking to stay on the sidelines and wait for events to calm down? Today, I'm going to use one chart. And as usual, we have two sides to the argument. On one hand, Kevin Muir, strategist at Toronto based East West Investment Management, is looking for reasons to dump his long positions and go short equities. On the other hand, Mark Mobius, co founder of Mobius Capital Partners, says that the stock market is going to do very well. So, which is it? Well, let's take a look, and you can decide. Kevin Muir has pointed to this chart from Jim Bianco at Bianco Research as the reason he's dumping his long positions in U.S. equities and looking for opportunities on the short side. The concern is that interest rates in the U.S. are too tight or too high for the world economy. According to Muir, the country with the world's reserve currency has the highest policy rate out there in the developed world. He further stated that if we look back over time, this has often coincided with market crises. Instead of lowering interest rates, Muir said the world should follow the U.S. lead and implement fiscal stimulus and stop relying on monetary madness. He continued that with the Fed so tight relative to the rest of the world, eventually it causes problems, big ones. While he's unloading stocks and looking to take stabs on the short side, he's not looking for a complete meltdown. Muir stated that I am not turning into one of those end of the world is upon us bears, yet I think the time to be heavily long is past. He further stated that the next 5 to 10% in the stock market is more likely to be down than higher. So, as this chart clearly shows, global central bankers are in an interest rate cutting mode in an attempt to avert or at least mitigate global recession. However, as opposed to the opinion from Kevin Muir, as we just discussed, that dynamic of global central bankers cutting interest rates promises to set the stage so that the stock market can continue to move higher with investments that offer dividends attracting investors. At least that's the opinion of Mark Mobius, the investment manager who co founded Mobius Capital Partners last year after a 3-decade high profile run at Franklin Templeton Investments. According to Mobius, globally, this is a really amazing situation. Mobius further stated that everyone seems to be racing to the bottom, which is actually going to result in the market doing very well. With interest rates where they are, stocks begin to look much more attractive since the average dividend is reasonably competitive with bond yields. And this is a concept that we've discussed on this channel here recently. Mobius has been a pioneer in emerging markets investments and has recently commented that disputes between US and China over trade policy were casting a cloud over global economic growth. In light of these disputes, support from central bankers in terms of rate cuts may provide the stimulus needed for stocks to remain buoyant, at least in the near term. European central bank actions expected include bond purchases, as well as cuts to the bank's key interest rate to prevent weakness emanating in China from hitting the Eurozone. In addition to that, Mexico's central bank cut interest rates recently for the first time in 5 years as its economy is faltering. Investors in the U.S. are increasingly expecting the Federal Reserve to remain dovish given the economic headwinds. It is notable that there is about $15 trillion in sovereign debt yields that are less than 0%. Essentially, this means that investors receive less than their original investment when they purchased government-backed debt. Mobius says that positive yield-bearing investments will be coveted. He specifically stated that you have lots of money chasing after where they can get some yield. He further stated, this is why I've been telling my analysts, Let's look for stocks that have some yield. That's what people are going to want. My opinion is that asking the world to follow the U.S. lead and implement fiscal stimulus and stop relying on monetary madness is a mad pipe dream in itself. The likely path of least resistance is continued lower rates. As such, I cast my vote with Mark Mobius, and I'm looking for the market to respond favorably. And soon enough, you'll need to cast your vote too. And for today, that's ChewDog Charts. Thank you.